So, you've heard the economy's doing great, but your wallet? It's been ghosting you since 2022. Interest rates have been stuck in place since late 2024, like your ex still using your Netflix account. Groceries feel like a luxury subscription box. And rent? It's rising faster than your screen time on a Sunday night. Welcome to 2025, where the Federal Reserve is the influencer you didn't know you followed, but somehow it still controls your entire vibe. Will they finally cut rates? Or are we in for another year of creative ramen recipes and economic whiplash? Let's break it down, simply. You made it through 2024. Rent's still climbing like it's training for Everest. Your grocery bill feels like a luxury shopping spree. And saving money feels as achievable as finding a unicorn in your backyard. Why? Because for over a year, the Federal Reserve went full throttle, hiking interest rates to tame runaway inflation. Then, in late 2024, they started easing up, cutting rates 3 times, bringing us to the current rate of 4.5%. Now, in 2025, they're holding steady, waiting to see if inflation behaves or throws another tantrum. What's the Fed's next move? And how will it impact your wallet, your loans, and your brunch plans? Let's get into it. The Fed's not hiking anymore. They've already cut a few times, but now they're just standing still. Why? Because the data is sending mixed signals, like your group chat trying to pick a brunch spot. Inflation is cooler than last year, but still running hotter than the Fed's comfort zone. Wages are up, jobs are holding strong, and people are still spending, just maybe not wisely. And remember those tariffs we broke down in our last video? That uncertainty? Still hanging over everything like a real housewife at a trade negotiation. So for now, the Fed's message is clear. We'll move when the vibes match the spreadsheets. So why should you care if the Fed hits pause, cut, or panic mode? Because it's not just economics. It's your life budget. Lower interest rates make borrowing cheaper. So if you've been side-eyeing a mortgage, a Ferrari, or finally starting that oat milk empire, this stuff matters. High rates? They mean more expensive credit cards, slower job growth, and businesses pulling back instead of hiring or expanding. And even if you're not borrowing, that sneaky little number set by the Fed still shapes what your boss can pay you, what your rent looks like next year, and how long your favorite coffee shop stays in business. Because even if you're not watching the Fed is watching you. So yeah, the Fed is watching. Now the real question is, what are they gonna do next? Let's break down the 3 most likely outcomes and why each one could either calm the markets or send Jerome Powell speed-running retirement. Option 1, the soft landing. Inflation cools on its own, and the Fed decides to hold rates steady, not in a rush to cut, but not tightening either. The economy stays stable, growth holds up, and Powell walks off into the sunset, maybe even trending on FinTalk for once. Option 2, stagflation. Tariffs keep prices high, but the economy starts slowing down. The Fed's stuck. Can't cut rates without risking more inflation. Can't raise them without killing growth. It's a policy trap, like your roommate who won't pay rent, but somehow keeps buying concert tickets. And finally, option 3, recession. Demand drops, consumer spending and confidence collapse. The Fed waited too long, and now they have to cut rates fast. Cue the market meltdown. and 12 think pieces titled, "Did the Fed Break the Economy?" So, what's the most likely scenario for the rest of 2025? Goldman Sachs recently lowered the odds of a US recession to 35%, thanks to improved trade dynamics and surprisingly resilient consumer spending. But the Fed isn't exactly popping champagne. The Atlanta Fed has struck a hawkish tone, flagging sticky inflation, tariff uncertainty, and an economic outlook that's still very much in flux. Markets are currently pricing in a 93% chance of a rate cut on September 17th, and just an 8% chance of any action at the June 18th meeting. Some investors are already booking Powell's beach chair, complete with a t-shirt that says, "Rate cuts are coming." But there's more. The Trump administration is pushing for rate cuts, with over $9 trillion in U.S. debt maturing this year. Lower rates would make refinancing that debt less painful. At the same time, tariffs have spooked investors, driving up Treasury yields and complicating the Fed's path forward. So, yes, the markets are betting on a September rate cut. But let's be honest, that's basically vibes with a Bloomberg subscription. Trying to predict what happens next is like reading a crypto white paper right before a pump and dump. The Fed's next move? It's less chess and more Jenga on a moving treadmill during an earthquake. And while economists argue on cable news and policymakers juggle inflation, debt, and political pressure, the rest of us are just out here HODLing.
This was explained simply. Hit subscribe. We've got a whole world to unpack.
Check out my video on how tariffs became a power move. Because yes, even real housewives get caught in trade wars.